Hey, Eric.
Hey, how's it going?
Good. Happy Thanksgiving.
Yeah, getting ready to get in the Thanksgiving mindset as we
Exactly.
speak. What's
Uh, I
going on?
wanted I wanted to talk today about EquityZen and Forge and the pre-IPO trading platforms that just got bought out by bigger players and sort of what the future is for these platforms and the secondary market as a whole. So, just as background, EquityZen, one of the bigger pre-IPO trading platforms where you can trade shares of companies before they go public, shares of companies like SpaceX or OpenAI, but even much more obscure ones. They got bought out by Morgan Stanley, and now they're going to be a part of Morgan Stanley, which is obviously a huge Wall Street bank, a big deal, and presumably they're Morgan Stanley is acquiring them to integrate that platform and that ability for their clients. And then in a separate deal, Charles Schwab bought Forge Global, which is a similar platformed equities, and there are a bunch of these. These are two of the bigger ones. That one, the amount of the transaction was disclosed because Forge is actually a public company. And Charles Schwab paid $660 million for Forge. And we don't know what Morgan Stanley did for EquityZen, but presumably the same thing. They're going to try and bring this technology to their clients. And so now, if you're a Morgan Stanley client or a Charles Schwab client, presumably sometime in the near future, you will be able to have better access to buying shares of companies like SpaceX or OpenAI. Where do you see this going? Do you think that all of these platforms are going to get bought up by other big companies? Is Goldman going to buy some company? Is JP Morgan going to buy some company? Like there are a bunch of these platforms still out there.
It's interesting, isn't it? This is like the culmination of we've been talking about democratization of alts, right? Everyone's going to be able to buy alts. How's it going to play out? We've been tracking for years, seems like a decade maybe, this thing that people want private market investment because they see the high return possibilities. They see the non-correlation. They get excited, right? You're at a cocktail party, your friend says, "Oh, I'm investing in some robots company." Like, that's cool. The first kind of version of this, I think, was like crowdfunding, right? So it was like, let's make product available to like the longer tail of investors at a very low minimum. This is more like, wow, we see there's a lot of trade in these secondary markets. So people want to own private companies, which is mostly venture capital. How do we bring that to where the money is, right? Because the money is actually not in these like boutique crowd platforms. Some of them have done well, raised $1 billion or more, but the real money is with advisor mediated accounts on platforms like Morgan Stanley. You mentioned Schwab. I mean, that's really where the capital is. So if you want to get the wallet share, you got to bring it there. So I think that's what you're seeing is the bigger banks and the bigger money platforms saying, hey, let's take what these people want and let's build that expertise. What's interesting about it is that they're purchasing these private market operators who have been building the expertise rather than just casting them aside, which I think tells you that there is expertise and there is a lot of differences to how these markets operate than just where the public markets go.
Yeah, I mean, and there's also the technology, the customer list, things like that. One of the hangups, I think, is that companies like OpenAI
Mm-hmm.
don't want people to trade their pre-IPO shares. There's a lot of companies that are not into this, and so I think you have to negotiate with these companies as well. So there, I don't know if OpenAI is just fighting a losing battle, and down the road, all of these kind of major pre-IPO companies are just going to have much more of a liquid marketplace, whether it's through Morgan Stanley or one of these platforms that has not gotten bought yet. Where do you see that going? Do you think that there's going to be a future where investors can just hop on to Morgan Stanley or their Schwab account and just buy shares, or is it going to have to go through this like whole process of getting the company approval and getting the transfer approved and all this kind of stuff?
I don't think if you're OpenAI, you really want to be in the business of chasing around some guy that put 25K in your company and worrying about if it's in this SPV or that SPV. I think these trades are not big enough. And at some level, you need the name recognition because if, part of the promise of this is that private is now public. Private is mainstream, meaning people want to own shares of these companies and get in and out of them. There's going to be liquidity. So you have to build a name. You have to, I mean, obviously OpenAI is on every news article written in the last 2 years, so they don't have to worry about it as much. But other companies that might want to stay private longer, I do think they want to control it, meaning not get too much information out, not have prices get out of whack. But I don't really think they want to prevent it because at some level, you do need demand for these shares if your strategy is to never IPO.
How about for companies that aren't as big as SpaceX and OpenAI? Companies that people may not have heard of or just smaller startups. How is this going to affect them? Is this going to give them greater access to capital? Do you think that investors just don't really care about any of these companies beyond the top 10, top 20.
I mean, if you look at the list of top volume on platforms like EquityZen and Forge and Hive, there's only 25 names that are really in demand all the time. And then there's another like 75 or so that a few people have heard of and are maybe building up a position in. But I don't think you're going to get primary financings through this. I think this is much more like, I want to own the top technology companies and I don't necessarily want to wait. I don't think all of the value is being created in public markets. So I'd like to get into privates. So yeah, I mean, I think people will have interest in 100 or so top names. It's hard to see like small startups benefiting from this, because at some level you do need to raise the capital. These are follow-on trades, not financings.
Yeah, I mean, I think that one of the things that is interesting about these secondary markets is that in some cases they can act a little bit as price discovery, and see which of these companies there is demand for at higher prices than when they've last raised. And maybe that helps them go out and raise again at that higher valuation. And then conversely, if things are trading below what they raised, that might not be that good for the company. And I think that's where a lot of these companies don't like this idea of the secondary market.
When people say, oh yeah, privates are going public. Well, how public really? How liquid do you really want this thing to be before it's ready? And then when it is ready, is there really no path to IPO? Like, do these things actually stay private forever? My gut is no. Like at some point, it just makes sense to go public because the costs are less costly than all this overhead that we're talking about. But we'll see, because, very few companies have gone public this year. I mean, this year's been better than last year, but still the floodgates have not flown open as they need to make this kind of, this secondary strategy diminish. For now, the liquidity is in the secondary, so everybody has to be there.
So what do you think is going to happen in 2026? Do you see more of these platforms being bought out? Do you see more investors jumping on these platforms?
Everybody wants to get into this trade at some level, right? We have, the buyout of the platforms, I think, has more to do with the fact that the larger managers need to get into this, and it's faster to get into it by acquiring a team that already knows what they're doing. But I think that when you look at a year, I think a lot of what's happening continues to happen, because I don't expect a dramatic change of where we are. Interest rates come down, people get a little more, confident, risk on. People start making investments in more of this type of stuff. You have this huge backlog of, what is it, 1,000 unicorns now that need to go public or exit or something. There's just a lot of backlog. And so I think the secondary trade continues for the next at least 18 months. After that, either you're getting into some kind of IPO golden age where all these companies that are backed up are coming out, and maybe the secondary stuff starts to diminish, or we just, this becomes a permanent feature of the landscape where companies really do just stay private for their life cycle.
All right, great. Well, thanks, Eric.
Let's get some Thanksgiving pre-IPO trades teed up for Friday.
Sounds
Until
good.
then, enjoy the
Bye.
holiday. Take care.